When I think about investing, the first thing that comes to mind is my responsibility toward my own future. For a long time, I believed that investing was something reserved only for people with a lot of money or those with advanced financial education. The truth is that investing is an essential part of my financial well-being, regardless of how much I earn or what profession I have. Over time, I learned that investing is not just about putting money somewhere and hoping for a profit, but rather a process of understanding, discipline, patience, and informed decision-making. The first thing I had to understand was the difference between saving and investing. Saving means setting aside money in a safe place, usually a bank account. It is useful for short-term needs or for an emergency fund. Investing, on the other hand, involves taking on a certain amount of risk with the purpose of growing my money over time. I realized that if I want my money to increase in value and not be eroded by inflation, investments are essential. Another important aspect was becoming aware of risk. At first, the word risk scared me. I associated it with massive losses, bankruptcies, or dramatic situations. In reality, risk in investing comes in many forms and intensities. Every financial instrument carries its own degree of risk, and the choice depends on my personal profile. I learned to ask myself, how much am I willing to lose in the short term in order to gain in the long term? Can I sleep well at night if my portfolio drops temporarily? Do I have an emergency fund for unexpected situations? The answers to these questions helped me understand myself better. For me, understanding the types of investments was a necessary step. There are stocks, bonds, mutual funds, ETFs, real estate, cryptocurrencies, precious metals, and many others. Each one has its own role in the economy and its own potential in my portfolio. For example, stocks represent a share of a company. When I buy stocks, I become a owner. Their value can fluctuate strongly, but they can offer good long-term returns. Bonds, however, are more stable. Essentially, I lend my money to a government or a company and receive interest. ETFs are an ideal solution for me when I want diversification without studying each individual stock. Another thing I had to learn is the importance of diversification. At first, I was tempted to put all my money into one promising investment. It seemed simpler and quicker. Over time, I understood that diversification is one of the most powerful tools for reducing risk. When I invest in multiple sectors, markets, or types of assets, I reduce the likelihood that a loss in one area will affect my entire portfolio. In other words, I try not to put all my eggs in one basket. Patience is another important lesson. I live in a world where everything happens fast. Information, technology, even daily decisions seem almost instantaneous. Investing, however, has its own rhythm. Capital growth does not happen overnight. I learned that volatility is normal. Markets go up and down, and sometimes those drops can affect me emotionally. But every time I feel the impulse to panic sell, I remind myself that I am investing for the future, not for the immediate present. Continuous financial education is, for me, the key to success in investing. I don't have to be an expert, but it is important to read, listen to different opinions, follow economic news, and understand why the markets move the way they do. Even when I delegate investments to a professional or use automated platforms, I remain responsible for my decisions. The biggest mistake would be to invest without knowing what I'm doing. Another principle I internalized is related to time horizon. Investments must align with my life plans. If I'm saving money to buy a car in 2 years, I probably won't invest in volatile assets like stocks. If I'm thinking about retirement in 30 years, then I can afford to take more risk. Every financial goal has its own suitable investment vehicle and its own pace. I also realize the importance of consistent contributions. It doesn't matter how much I invest each month. What matters is that I invest regularly. This strategy, known as dollar cost averaging, helped me buy when the market was both high and low, reducing my emotions and eliminating the pressure of trying to time the market perfectly. Regularity in investing has become a form of discipline. I also learned that I must stay away from get-rich-quick promises. There are many seemingly tempting opportunity schemes that guarantee profits. People who claim they've discovered the secret to success, or investments that appear too good to be true. Experience has taught me to be skeptical and always verify my sources. In investing, if something sounds too good to be true, It usually is. When I first started investing, I also confronted my own emotions. Every market fluctuation affected my mood. When I had profits, I was excited. When I had losses, I felt frustrated. I learned that investments should not be guided by emotions, but by reason and strategy. I set a plan for myself, and I try to stick to it, regardless of what happens in the short term. Finally, perhaps the most important lesson for me is that investing is a journey, not a destination. There is no perfect moment to start. There is only the present moment. The earlier I begin, the more time my investments have to grow. Every decision, every mistake, and every success contributes to my financial experience. Today, when I look back, I realize that investing is not just about money. It is about responsibility, independence, and my ability to shape my future the way I want. It is about believing in myself and wanting to grow. And although I still have much to learn, I am convinced that every step I take in this direction brings me closer to the financial stability and freedom I desire.